Okay, so now we learn how to analyze and record transactions for merchandise purchases using a Papertree system. And the Papertree system basically means once a transaction has occurred, we update our accounting book. So let's see, if we do a purchase without a cash discount, so the cash discount means if a buyer pays in cash, that buyer would get a discount. So the buyer would pay less. The reason is that cash is more preferred payment than credit. Okay, if the buyer pays with a credit, then the seller has to spend days or even months to get the cash collected. So the seller actually, you can see they prefer cash. So if they so they would yield some part of the profits just to receive cash for a quick transaction. So right here, there's a purchase without this cash discount. So when this company called Z-Mart purchased $500 and they pay back cash, so what see on its general journal is that the merchandise inventory increases by 500. All right, so when assets increase, that's a debit. Meanwhile, the cash got reduced by 500, so that's a credit. And if there is a credit terms, so there would be a deduction from the invoice price if the early payment is delivered. So right here, you have an entire credit period from day 0 to day 30, for example. And then you have a date of invoice. It's the date when the sale is recognized or the merchandise is purchased. And then if you can deliver the payment within this short amount of period, okay, then you will get a discount for the merchandise you buy. So this is a different price applied right here. And then if your payment is made after this discount period, you just pay the regular price on the invoice. So here is the form of describing the purchase discounts. So you have two ratio-like fractions. So the first one is 2 over 10. So 2 means 2%. 2% would be the discount amount if this payment is delivered within 10 days after the purchase. So if you pay within 10 days, you get a 2% discount. And if you pay within 30 days and over 10 days, then you would pay the all bill. Okay, so if you pay over 30 days, so basically that's not allowed, or otherwise it's called a default payment. So the 30-day right here would be called a credit period. So from the date of purchase, you have 30 days to pay the bill. If you paid within 10 days, then you enjoy 2% discount. Otherwise, you would pay the full bill. So that's how it says. So right here, we have this example. If November the 2nd is the date of purchase and the merchandise is in total $500, since there's no cash payment, then when the purchase is made, then there's also a liability being built up. That is called accounts payable. So today you don't pay money, but you have to pay later. Okay, so this item is called accounts payable. And you also have the term specified here, 2% for 10 days, otherwise the net or the all for 30 days. So this is a typical invoice. And right here, it says the date of a purchase. And also it says the seller of the company, which is called a Trex. And also this is the information of the buyer. Okay, that's yourself, Z-Mart. And also you have the date, okay, for delivery. And also you have the terms right here. And you also have a FOB. FOB means free on board. And we will explain that later. And number 7 here is the amount, it's the items that are sold or purchased by you. And also you have a number 8, that is the total amount of the merchandise in dollars. And number 9 right here is the net amount. If you deduct the discount of 2%, so that's how much you would pay. So right here, so on November the 12th, which is 10 days after the purchase, so if you pay within 10 days, then you will enjoy a discount. So basically, when you use the discount, you only pay $490. And $490 would satisfy the bill of $500 accounts payable. So your account payable will be reduced to 0. It was $500 credit, and now it is put as $500 debit. So your payable reduced by $500. So the difference of $10 would go to merchandise inventory. So that means your inventory actually is worth less in dollar figure. It's still the same merchandise, still the same products, same amount of commodities. It's just on the book, it's worth less money. All right, so you will see a $10 credit being put in there. So that means this inventory at dollar value has been reduced. Okay, so for the merchandise inventory, when the purchase started, it was 500, and when a discount is realized, the worth of the inventory is changed to 490. And for accounts payable, it's just all gone, and you pay $490 cash in there. So another case is if you pay on December the 2nd, which is 30 days after, then you just pay the full amount, $500 cash. Okay, so sometimes when we do purchase, we may return the item if there are some default or defects or bad things or damages. And sometimes we ask for a price deduction, okay, if we do not return them. If we keep them, then we need the seller to give us a price deduction. So if that's the case, this is how we build our item. So for purchase allowances, so this is our story. On November the 5th, the buyer or you issues a $30 debit memorandum for allowance from Trex for defective merchandise. So that means some of the merchandise, some of the product is damaged, okay? It has shortcomings. So then you would ask the seller to give you a $30 credit. So what would happen is the account payable will be reduced by $30. Okay, so you pay them in the future, you will pay them $30 less. And your inventory right here also got its value reduced. Just because you pay $30 less, then your inventory value also is reduced by $30. And here's another story, okay? So the Z-Mart, the buyer purchases a $250 worth of merchandise on June the 1st with the terms of 2% in 10 days and all net in 60 days. So on June the 3rd, Z-Mart returns $50 of a goods before paying the invoice. All right, just for defects, they return it, and they did not ask for allowance. And when Z-Mart pays on June 11th, which is 10 days within, it takes a 2% discount only on the $200 remaining balance. So what happened here is when the purchase was first made, the merchandise inventory increased by $250. At the same time, you need to pay $250 in the future. That's billed as accounts payable today. And then 2 days later, there are returned products of $50. So your accounts payable will be reduced by $50. You just pay them $50 less in the future. Okay? And then your inventory also got its value reduced by $50. On June 11th, 10 days after, you will pay the remaining balance. So it's a $200 accounts payable need to be satisfied. So that's 250 minus 50. So that's 200. And how do you pay the 200? Well, you only need to pay $196 cash for it, and that's it. Okay, you only pay this much. You do not pay $200 because you pay early. You enjoy a discount. You will see there's a $4 difference here. That $4 will go to merchandise inventory as a deduction of its value. So just because you pay $4 less, the value of the merchandise you purchased is worth $4 less. So that's how we do accounting. Still, it's the same inventory, the same products, same stuff. It's just the value on the book is reduced.